Hello and welcome to Deal Flow, the show that puts the spotlight on merger and acquisition activity on the African continent. I'm ERIKA van der MERWE. Thomson Reuters' latest analysis of M&A activity in sub-Saharan Africa suggests that the talk of Africa's opportunity and potential is not all hype. Investors actively are seeking assets across the continent. Notably, there's plenty of interest in Africa from emerging market investors. We'll bring you the detail on all of that with our guests. But first, a quick look at some of the deals that have made news this past week. Adcorp has concluded an agreement with the current shareholders of Labour Solutions Australia to buy 100% of Labour Solutions Australia for R421 million. US Airways and American Airlines will offer to give up some takeoff and landing slots at Washington, D.C.'s Ronald Reagan National Airport. This in an attempt to get the United States Justice Department to allow their merger to proceed. This deal would create the world's largest air carrier. QATAR'S sovereign wealth fund, one of the world's most prolific investors, is building a $1 billion holding in Bank of America, seeking to benefit from the US economic recovery. This according to a report from the Financial Times. And chipmaker Intel is having second thoughts about getting into the television business and is in talks with Verizon Communications to take over its Internet TV initiative. The value of merger and acquisition transactions in sub-Saharan Africa in the 9 months to September this year reached more than $23 billion. That's up 80% from the same period last year. The region is looking hot, it seems. Keith Nichols is Managing Director for Africa at Thomson Reuters, and this is his data. And joining us from Lagos, Nigeria, Mayowa Amu. He's Head of M&A at UBA Capital. Welcome to both of you. Good to have you here in studio. Keith, I'm starting with you. This 80% surge in the numbers, so first 3 quarters of the year compared with the previous year, it sounds impressive. But we do know there were some outliers. We've spoken before on some of this data. There were 3 major power deals in Mozambique. So if we were to strip that out or smooth that out, in your opinion, what's the trend?
Yeah, you're right. I mean, you see that about 40% of that deal volume of that $23+ billion is from those top 3 deals in Mozambique in the oil sector. But I still think that oil and energy is really driving most of the M&A on the continent right now. But deal volume overall is down from what it was. But these mega deals, these very large deals, are causing that 80% surge from the first 9 months of last year in comparison.
Mayowa, Nigeria and West Africa is certainly one of the hot spots in Africa where there's plenty of energy. So from your vantage point, what sort of deal flow, what sort of activity are you seeing?
For us in Nigeria, what you traditionally find is investors looking to this part of the continent look at Nigeria as a platform to get into not only Nigeria but West Africa. So in terms of sectors that are attractive, you've got financial services. Interestingly, you've also got oil and gas and power, which sort of mirrors the overall trend that Thomson Reuters refers to. And I think it's important to mention that international recognition has been given to the fact that the pace and size of the recently concluded privatization of the power assets is perhaps one of the biggest to have ever been done in one shot in the world. As you know, many of the international oil and gas companies are also divesting of their marginal field assets for various reasons. For instance, you know, Chevron is in the market, Shell is also in the market. So those are the kind of deal flows that we have in this part of the continent.
So interesting, Keith. So what both of you are saying, that this energy in the power sector, it still has legs, and it's not just a case of 1 or 2 deals. It's not a lumpy sort of trend that we're seeing. There's more to come.
No, absolutely. I mean, I was going to say, to the counterpoint, the 4th largest deal is actually a Nigerian oil deal. but you see a significant number of smaller deals happening in the Nigerian area as well. But oil and gas is definitely leading the charge here.
So clearly, it's the economic opportunity, but also some of the regulatory changes driving this activity.
Yes, absolutely.
And on the telecoms and communication, I'd imagine regulation once again plays an important role there. Is this also an important sector? Have we gone over that trend?
I think so. I mean, I think you don't see it necessarily in the deal flow, but you definitely see it in investment. I mean, in terms of people taking stakes and people taking positions in telecoms, and just the growth in the telecom sector in general, just organic growth.
Mayowa, in general, if we looked at infrastructure broadly defined, so there's telecoms, there's also social infrastructure, transport infrastructure. Is there a lot going on building that spine across Africa, crisscrossing the continent and enabling further economic activity?
Yes. I think, although important to mention that compared to more developed markets, telecommunications penetration is still definitely lagging behind. The bulk of the activity that we're seeing in telecommunications is more as it concerns the infrastructure space. So you find that many of the telecommunications companies are focusing more on marketing, brand building, increasing and maintaining their customer bases, and while they're going into infrastructure sharing arrangements and sometimes outright divestments of those infrastructure assets.
If we look at who's doing the deal making, Keith and Mayowa, it's interesting that the emerging market, the giants, are doing plenty of these deals, and no surprises that China's top of the list in terms of doing the deals. India second. We've got South Africa, of course, Nigeria, and Brazil on the list.
Absolutely. I mean, it's I think I mentioned this last time we spoke. It's that comfort level with Africa, and the people that are investing in Africa have that comfort level. China's obviously been on the continent for a long time. India probably not as long as China, but obviously South Africa knows the continent very, very well. And that a lot of that deal volume in South Africa is South Africa investing in other South African companies. So again, it's that comfort level, the level of information investors have on the continent.
Well, there's lots to say about this and unpack about this, Mayowa. And I've often heard this say that perhaps the advanced economies, and it also includes some of the South African deal makers, losing out on the opportunity, being uncomfortable with looking at an emerging market. And you're seeing the Indians, you're seeing the Chinese and the Brazilians coming in. They're not concerned if it's not a proper pucker, sort of tidy office and in the conventional sense that they used to. They see the opportunity. Do you see that in Nigeria and in West Africa?
Absolutely. I think from my own perspective, I think you can sort of classify the investors into two buckets. So you've got the Indians and the Chinese, from Asia. They've got large populations, they've got a lot of cash, but what they need is mineral resources, which is why Africa is interesting for them. The other bucket will be the Europeans. The Europeans are focused more on growing consumer base, consumer goods businesses in food and beverage, personal and healthcare. So indeed, I would say the flow from maybe South Africa to other parts of the continent, definitely compared to what you find from Asia, is less. But that is something that is perhaps due to sometimes political interference, sometimes, like you rightly pointed out, maybe just not being comfortable enough to take those risks. But I think what you will find in coming years is that because there are some significant investors. I'm sure you all know what Dangote is doing in different parts of the continent. I think it's more likely than not that you continue to find such more high-profile investors, entrepreneurs looking outside of Nigeria to other parts of Africa to take investments.
Right, so the intra-Africa trade and investment that you're talking about, and so exciting that we see governments across the continent becoming aware of the importance of that and trying to reduce the bureaucracy of Africans moving across borders. But Keith, I'd like to close by asking you about the funding of these deals, equity and debt. I see there seems to be a surge in debt funding, which is interesting because we're always told that debt capital markets in Africa are underdeveloped.
It is interesting to see. I mean, it's I think just the little amount of data just in the first 9 months it's a little dangerous to draw too much inference from that because they are again skewed by some larger debt financing. Right. But it is interesting to see.
There was a South African bond issue.
I was going to say it's a $2 billion South African bond issuance that skews that number pretty high. But it is encouraging to see that bond market and that debt market taking off in Africa. And again, as more of those happen and more of them are successful for longer term investing, you'll see more of these types of deals in Africa.
Mayor, a comment from you on funding of deal flow activity in the region. Were you active equity versus debt and also the secondary trade in some of these assets?
Well, I mean, I totally agree with Keith. I think what you will find continually is more sovereign bond issuances, especially on the international market. But coming back home, if you took the recent power privatization transactions that were just concluded, there was quite some initial hesitance about whether the local market had the capacity to provide the necessary funding for those assets. I think it's also important to say that many of the international banks actually, should I say, sort of stood back to see the way funding of these transactions would evolve. And here we are today. The bulk of those transactions were indeed funded by the local banks using commercial bank debt, although, I mean, you could argue that certain specific risk mitigating requirements were made of the promoters and the sponsors. But I think that notwithstanding, the level of confidence that the Nigerian banks and the domestic banks have demonstrated by providing the funding required to conclude these transactions, I think it's something that is very, very significant. Perhaps
if you were to compare your area, the African region, with the deal flow you track elsewhere, what are the major differences?
Again, I mean, it's deal volume and deal size. I mean, deal size is skewed heavily in one sector here, whereas it's probably more spread out in other areas. And that talks about what we talked today in terms of China needing energy and minerals. So that's the way it flows.
Keith, thank you very much. Good speaking to both of you. That's a wrap of this edition of Deal Flow. Our thanks to Keith Nichols, MD for Africa at Thomson Reuters, and also Mayowa Amu, Head of M&A at UBA Capital in Lagos, Nigeria. Do join us same time next week for your weekly dose of mergers and acquisitions in Africa. Good night.